As the city of Los Angeles burns, the fire changed the city's face forever. Homes reduced to ash, lives destroyed, and dreams quickly evaporated. And while the battle to extinguish the fire continues, there is another fire that has not been extinguished. It's threatening to rise and spread again. This is the fire of inflation in the economy. After a period of the Federal Reserve battling inflation by increasing rates, it appeared as if inflation has been contained. But the Federal Reserve has fallen into its classic mistake of abandoning the battle before the fight to extinguish the fire is over. Now, the threat of the inflation fire growing and spreading back into the economy is becoming real. In focus tonight, the fire. All right. Today is Monday, the 20th of January, and here it is, folks. We're bringing it back, baby. In focus macro discussion today. And oh, by the way, happy Inauguration Day. You guys watching what's going on here? Look at the new president. He's so happy. He looks he's on drugs. I mean, I never thought that we're going to have an African-American president in my lifetime. Now we got two of them. We got the dark chocolate and the white chocolate, and this one was not born in this country for real this time around. And then, of course, the president made a mistake. He did the salute thingy. Aw, look how cute he is, right? With the salute thingy. But I don't know. People say it's a salute. I say he was just waving for his Cybertruck to stop. I can't really criticize my cult leader. But in all seriousness, folks, you know what's really refreshing about today is witnessing the amicable and civilized transfer of power in our democracy. Did you guys see how President Trump walked Joe Biden out of the White House? It was so civil. I'm proud of this democracy, folks. But you know what else happened over the weekend? Unfortunately for me, I lost a lot of money. I don't know if I'm going to have a home by the end of the week because I got into this Trump coin scam. I invested my life savings in the Trump coin. And next thing you know, it goes down by 50%. Why? Because the Melania coin was launched. And the money was moved from the Trump coin to the Melania coin, which, by the way, crashed after that by about 70% or so. Kind of a nice start for the new administration, scamming everybody and collecting some foreign money, money laundering. You buy the coin when you're the government of China, right? And then the president does favors to you after that. But it's all business, folks. Let's not just read too much into it. I cannot criticize my cult leaders. This is my party. And that's why I'm going to give them a pass. Even though I'm going to be homeless at the end of the week. And you know what makes me feel pretty good? At least I was not scammed by a fake Brad Pitt. You see that story of the AI scam using images of Brad Pitt pretending to be sick and he needs a kidney transplant, and they scammed the poor French woman out of $850,000. Because, Brad Pitt was sick and he needed money, so he told her that he loves her and appreciate all of that, and she should leave her husband for him. And she did, for the fake AI. Brad Pitt, I mean, this is a sad story. I shouldn't laugh, but I think the scam would have worked out better had they used George Clooney, because the guy's known as a prankster. But you know what's really sad about all of this? I mean, how desperate do you have to be as a woman to fall for this crap? Think about the husband. That piece of shit probably didn't give her any attention or affection. I left her drier than an LA fire hydrant. Speaking of LA fire hydrants, which were empty, by the way, and everything was burning, and we had no water in the reservoir, the courtesy of the beloved and caring government of California. Oh, they put the citizens first all the time. I'm not going to blame dear Governor Kim Jong-un Newsom for the disaster. I'm going to blame climate change. It made all the fire hydrant dry. And because it is the climate change, I blame the private jets. And because it is private jets, I'm blaming the whole fire on Taylor Swift. But you know what bothers me about all of this, folks, in all seriousness? Some of you are happy about this fire. Hey, Maverick, why are you so sad? Why are you defending? Those are the libs. They're the Hollywood people, the rich. Burn them, who cares? First of all, this is my city, bitch. You think I'll be happy seeing it burn? Number one. Number two, who gives a shit if they're rich or libs or Republicans or whatever? This is America, my friend, and it is burning. One of the most beautiful parts of the country. Burning the ash. Nothing. I don't think that's the reason for being joyful at the misery of others. But problem is the misery of others are going to spread all over the economy because this is the second largest city in the U.S. Population-wise, probably the largest city. And we're talking about the impact of inflation coming from this fire. See, now they say that the wildfires cost $135 billion in economic losses and counting. The latest number that I've seen is about $250 billion. Certain estimates say that the damage could cost more than $500 billion. Who do you think is going to pay for all of this? If you said the insurance companies, let's short the insurance companies, right? Look at the KBWP. This is the Casualty Insurance ETF. Yeah, it went down big, but be careful here because, you look at Mercury Insurance. That's going to be one of the most exposed. Sure, maybe this one will go kaput, but at the end of the day, listen to this. State Farm, one of the biggest insurers in California, canceled hundreds of homeowners' policies last summer in Pacific Palisades, the same area which is now being ravaged by a devastating wildfire, per Newsweek. So now the insurance companies are actually off the hook. And those who are not off the hook, well, guess what's going to happen? Insurance companies going to cry and say, oh, we're going to have to declare bankruptcy and lose a bunch of jobs in the economy. And the government, aka the taxpayer, you and me, baby, will bail them out. It's an amazing business model. You collect the fees from the customers. Then when the disaster hits, you don't pay them. You cancel their policies. Or if you forgot to cancel their policies, the government will bail you out. It's the most genius business model in history. But the problem at the end of the day, my friends, is as we bail out all of these insurance companies and we fix the, $250 billion, $500 billion in damage, where do you think that money's coming from? We're going to have to borrow the money. And we already have high interest rates and rates continue to go higher. You think that's not going to have an impact in the overall economy? Think again, buddy. Not to mention, of course, the inflation effect that comes from these fires. Here's the headline for you. Notice how these numbers went higher so fast. Headline number one reads, Los Angeles fires could push up rents across the city by 8% or more. Experts warn. The tens of thousands of residents are now without homes. Everybody gonna stampede and try to rent the same apartment, right? So it went from 8% to this second headline. Some estimates for single-family homes in Los Angeles area shows they're reportedly being listed for nearly 20% higher since the wildfires started, per the LA Times. So it went from 8% to 20%. Here's the third headline. LA rentals hit $40,000 a month as fires worsen housing squeeze. And here it is. We went from 8% to Los Angeles landlords jack up rent by as much as 124%. There we go. You think that's not going to show up in the national economy? You think that's not going to show up in the national data and the upcoming series of the CPI? Because I know what you're thinking. Everybody's jerking off this week to the CPI being tame. In reality, it wasn't really tame. Inflation was higher, and it beats expectations. There was only one below expectation rating, which is the core CPI month-on-month. It came out a tick lower than expectations. Needless to say, inflation is still going higher. Of course, folks took a sigh of relief when they've seen interest rates, bond yields going down after the report and the market going higher. But listen to CNBC's Rick Santelli, because he's going to explain to you why we've seen the drop in bond yields. And of course, when bond yields go down, the algorithms take a signal and they buy the market. Listen to why he thinks that happened.
These are large moves. A 10-year from an intraday perspective, Joe, is at the lowest yield right now since the 3rd of January. 2-year note yields, of course, are making new passes at low yields for all of 2025, which I understand isn't that old, really. And maybe the other thing that you want to pay attention to, momentum building. This is the 4th consecutive session, a 10-year and 30-year trading below the previous day's low yields. That's important. Now, I wouldn't try to necessarily tie all this to great news on inflation. I think it's more about positioning. And why do I bring that up? Because long-end rates went wild. Now they're going wild a bit in the other direction. But it doesn't mean the Fed's going to go wild easing because of the move we've seen post-PPI and post-CPI. Back to you.
And I agree. I think that the drop in bond yields happened because of positioning. So somebody's positioning that we'll see a hotter CPI or hedging. That's how you always hedge. So you're basically betting, shorting bonds and betting for higher yields. The rating comes out just a little tame. You take out that positioning, causing volatility in the market. That's the bond market. And then the algorithms take that signal and they move the stock market higher. But at the end of the day, we talked about this in the last weekend's video. We said that nobody's really worried about the December CPI report because we haven't seen an increase in commodities prices during that month. What we are worried about, and it's just a matter of time, if it's not this month, if it's not next month, it's the month after. Just a matter of time. When do we see that report, CPI inflation report, that changes the game, that says, watch out, we're not even close to the Fed target of 2%. And the risk right now is inflation is moving up. It's moving higher. And we're going to have to change the policy one step at a time. When we look at CPI year-on-year inflation, you pin it against commodities. Great correlation, right? I mean, commodities kind of responsible for inflation. Rise of commodity happens because of devaluation of the dollar. Devaluation of the dollar happens when we have easy monetary policy and stimulus and reckless policies from the fiscal side. In any case, commodities are beginning to catch up some steam so far this month. Month is still young. We got about, 9-10 days left. But look at the month-to-date performance of some of these commodities. Heating oil, aka diesel, that's up over 13.5%. Soybean oil, about 13%. Oats, about a little over 9.5%. Even crude oil is up over 8%, 7% for the month so far. Nat gas, up almost 8%. Copper, up almost 8%. All of these commodities going higher. That's going to be reflected in inflation sooner than later. And we're talking about the most dangerous part of inflation. We're not talking about, cocoa prices went higher. No, I don't eat chocolate, so who gives a shit? No, I'm talking about heating oil. That's diesel. That's transportation across the economy. Up at least 13% this month alone. Of course, the naysayers will dismiss this as, it's the beginning of the year. Commodities go higher, then they go down. And, we got a soft landing. Inflation is gone. But I'll show you the trends. You let me know what you think. Maybe the trends are lying. Maybe it's different this time around. Just let me know in the comments. But one step at a time. We also got consumer confidence going down. Why? Because inflation expectations go higher. If the consumer is expecting higher inflation, it becomes sort of a self-fulfilling prophecy where the producers begin to increase prices because they know that the consumer is expecting to pay more. Another important leading indicator, which you're looking at right now in blue, is the prices index for the non-manufacturing, aka services ISM index. You can see that it is a great leading indicator to the line in gray, which is the inflation rate. And so far, we've seen a massive spike in non-manufacturing prices, leading us to believe that the CPI will do the same. If the CPI does the same and it stops trending down, meaning it's getting away from the hands of the Fed in the wrong direction, then what do we think about interest rates? Do we think that the Federal Reserve will continue to reduce interest rates, or will we think that the Federal Reserve maybe will pause or increase the rates? Right now, the consensus says that we're probably going to be at 3.5 or less still, but you can see the difference between December 19th and Jan 10th. Expectations are beginning to shift toward, we might actually have a higher interest rates at the end of it than what we anticipated. Even Goldman Sachs and JP Morgan, they revised the Fed outlook to show no rate cuts until at least June 2025. Bank of America says no rate cuts this year at all. Now, here's what I would say. It ain't about the cuts. The question is, when do we talk about the hikes again? Because if we continue in this pattern and commodities continue to go higher, what's going to happen is the same thing that took place before in the 1970s and 80s. And we overlay these charts on top of each other. I mean, this is kind of lagging. November reading 2.7, the CPI. The latest reading in December is 2.9. So we're moving up. And from past experience, we know that the increase in inflation can happen rapidly. Before you know it, you're already above 8, 9, 10%. Is there a leading indicator that tells you that there is a problem? Yes. So what you're looking at right now, let's start with the easy one, CPI inflation in blue. Then in red, you got the federal funds rate. In green, I guess, you got the U.S. 2-year Treasury yield. And finally, in purple, it's the S&P 500, the stock market. Notice the correlation here. Inflation begins to rise, but it's dismissed as, it's just normalizing of inflation or whatever. Equities do pretty good. The bond market doesn't move. The Federal Reserve in red doesn't do anything at all. But then inflation begins to move significantly higher at levels that we're not comfortable with. The Federal Reserve in red says, I don't really care right now. It's transitory. And the stock market in purple says, I guess, maybe. But right now I'm going to dismiss it. Who says that no, this is a problem? It's the line in green. That is the 2-year yield. It begins to move ahead of time. anticipating that the Fed in red will follow through. And next thing you know, in red, the Federal Reserve indeed begins by increasing rates higher. Then as they increase rates higher, we see the line in blue going down. We see the line in purple going down. Stock market goes down, inflation goes down. The wealth effect is diminished, and that helps with inflation. So what we know is the line in red follows the line in green. The Federal Reserve policy follows what the 2-year yield does in the bond market. And recently, the 2-year yield is beginning to firm up again. And we see the line in blue beginning to firm up again. Why? Because the Federal Reserve decided to cut rates. As you can see, the line in red is declining. This right away tells you that you have to look at the 2-year yield. If it continues to go higher, that's a leading indicator, a warning sign saying, folks, the inflation rate is moving higher. And next thing you know, the Federal Reserve will have to raise rates. And as they raise rates to push inflation back down, what do you think happens to equities? Keep that in mind. And this is a classic mistake that happens pretty much all the time, folks. The chart that you're looking at right now, in white, this is the Federal Reserve funds rate. And in orange, you got the CPI. You can see that what we have right now, inflation ticking higher, as the Federal Reserve funds rate ticking down, they began cutting rates. It's what happened back in 2007, 2008, when they began cutting rates. The line in orange went higher. You can see the same thing in the early 2000s. You can see it also in the late 80s. Every time the Federal Reserve begins cutting rate, we see a resurgence of inflation. Part of it because the Federal Reserve is a chicken, pretty much. They talk tough, but once they begin to see that inflation is heading down, but the equities market is also down, and we see a little bit of distress in the banking sector. The Federal Reserve becomes a chicken, and they back off, and they begin to pause, and then cut rates. At the end of the day comes the next part, which is you cannot really tune it exactly to the right moment where the Federal Reserve should be cutting rates. So there's going to be a margin of error. Either they're going to do it a little too late or a little too early, then they have to adjust. And this is why we see this problem. But we know that when they abandoned the fight too early, as they did in 23, because the equities market was down, I know we got some problems in the regional banks. We know that the risk here is probably that they're not cutting too late, but actually cutting too early, which means that the orange line is likely to go higher. That's CPI, that's inflation. Let's zoom in a little more and study this case in details. So what you're looking at right now is the financial crisis 2004-2010. In white, once again, the Federal Reserve funds rate. In orange, the CPI. And then you have in blue, oil. Notice what happened when the Federal Reserve began cutting rates, when the white line began to decline. Immediately, oil and the CPI moved higher together. So oil is a leading indicator to what's going to happen to the CPI because oil dominates costs across the economy, from transportation to travel, shipping. And I know a lot of folks say that it's different this time because we have oversupply. The United States is supplying more oil, Saudis supplying oil, and the demand in China is weaker. If that is the case, then how come oil is rallying impressively so far this month? Because we know that, yes, these are all factors that impact the price of oil in the long run. But at the end of the day, the most powerful impact on the price of crude oil is the Federal Reserve's policy. We know that oil loves and thrives when the Federal Reserve begins cutting rates. And that's the risk that we have to assume this time around. Let's go back to the dot-com days. So you can see in the late 90s, once again, in white, the Federal Reserve's fund rate. In orange, the CPI. In blue, you got oil. So the Federal Reserve begins cutting rates. Why? Because inflation went down. They raised rates, inflation went down, they declare mission accomplished, they begin cutting rates. Next thing you know, CPI and oil bottom around 99, and they begin to move higher. At some point, the Federal Reserve has to capitulate and increase rates. And as they do that, let's plug in another player here. See the red line that I got for you? When the Federal Reserve fund rates makes a higher high from where it stops and began declining, the cuts. Plug in the NASDAQ in green. Watch what happens. We see the end of the bubble, the crash. So at the end of the day, and as I said in this channel repeatedly, you're not going to defeat inflation, Mr. Federal Reserve Jerome Powell. And I don't mean defeating as in, oh, it's going down a little bit. No, I mean extinguishing the fire. It will never happen without crashing the market. It's a price that we have to accept. The market been going higher for 15 years now, based on the sugar high and artificial pumping by the Federal Reserve. If you choose to back off to save the banks and to save the market, inflation will come back. It'll take time and it'll feel that we have a soft landing, market goes higher, inflation goes down. But sooner than later, inflation will make a comeback. And when it makes a comeback, now you need a bigger crash and a bigger impact on the economy to eradicate it from inflation. And that's why earlier recessions usually are a lot better than recessions happening later, after we all know that the Fed lost the battle. Because with that comes panic, and panic causes exaggeration of moves. You get the deal. But let's go to what we have right now. You can see that the Federal Reserve Fund rate in white is declining as the Federal Reserve cut rates 3 times last year. And coincidentally, we begin to see oil finding a footing in blue. We begin to see the CPI finding a footing. So it's too early right now, but it's something for you to keep an eye on. If you continue to see oil going higher, if you continue to see the 2-year yield going higher, those are the leading signs that the CPI is going to go higher, and the Federal Reserve will have the hike rates, not cut, hike rates to contain it. This is not something new. This is not an anomaly. This almost always happens. The Federal Reserve falls into the same mistake over and over and over again. They cut, inflation comes back, then they have to raise, and at that point, that kind of chaos causes economic distress. When we talk about the fire, ladies and gentlemen, what is the spark? What is the fuel of the fire? How about the devaluation of the dollar? Well, you might say, but Maverick, the dollar been rallying significantly higher. Yeah, that makes it even more scary. You know why? Because commodities been rallying, finding a footing, and inflation been rebounding despite the rising dollar. Imagine what will happen if the dollar begins to trend down and weakens, as we expect it to happen because it's inevitable, given the new administration's policies. And oh, by the way, next week we have a 90% chance that the Bank of Japan is going to hike rates. Why is the Bank of Japan important? Because if they do and firm up the value of the yen, the dollar is going to go down. Because the dollar's strength is stemming for the most part right now from the weakness of other currencies. So if they begin to firm up, ECB begins to pause and increase rates, for example, euro is going to go higher. What about the Bank of England? We're going to start with the Bank of Japan, so if the yen goes higher, dollar is going to go down. And with that, commodities will continue to move higher. On top of that, if commodities prices go higher, then we're going to see bond yields also going higher. But on top of that, we have the disgraced, the worst Treasury Secretary in my lifetime, Janet Yellen, who destroyed this country like Nero. But you don't see it yet, but you will see it. Because what she's done is irreparable damage, permanent damage. And we know why she did it. The manipulation in the yield curve, she did it because she wanted the equities market to go higher before the elections. And she lost anyways. Now she says, oh, as the new administration comes over, Jan 21st, we're going to have extraordinary measures because we have this insane deficit and higher rates. So that could have an impact on bond yields. Folks, it ain't just me outlining this threat. Even the Wall Street Journal is beginning to catch up to this fact. James McIntosh wrote an article that I don't have to wipe my ass with. That happens once in a while. He said, what if the Fed U-turns and raises rates this year? ? Now, is it going to happen right away? Is the Fed going to raise rates tomorrow? Of course not. They take a long, long time to begin to raise rates. Oh, they cut right away. The moment we get a problem, the moment we see market going down or some oligarch complaining, they cut rates right away. But it takes them a long time to raise. That means that they have to be certain that inflation is indeed heading higher. It's a huge risk that they cannot take, so they have to capitulate and raise rates. That is a recipe for raising rates too late. Keep that in mind. At the same time, you might say, okay, Mav, maybe you convinced me a little bit that there is risk with the Federal Reserve hiking rates. Are they really going to do that when we have weakness in the economy, such as consumer credit card debt plunging as it did before financial crashes? As we see delinquencies rising, as we see when you peel the onion, that full-time jobs declined by 350,000 month on month. And as we see the consumer getting weaker, the middle class, the lower middle class, the not so fortunate class, we got some earnings from a company like Constellation Brands. That's a pulse in the economy. Bars, restaurants, and the CEO cited uncertainty about consumer spending. The consumer is getting weaker. Yeah, it'll be devastating if the Federal Reserve raises rates right now, because the economy already has a side that is weakening dramatically, while the inflation risk continues to be high. You try to extinguish the inflation fire, you'll cause more damage on the other side. But do we have any other solution? No, we don't. Look at the contrast, for example. Constellation Brands says the consumer is weaker. Delta Airlines say that we're doing better than ever before. Why? Because of strong demand from premium travel. The affluent consumer is spending, and they're keeping inflation alive. And they're doing so because the market is going higher. The wealth effect. At the end of the day, you're not going to solve the inflation problem in the economy unless you tame the affluent consumer. You got to scare them a little bit to spend less. And you're not going to achieve that without a steep market decline. You can extend the game all you want, expand the bubble as high, as big as you can. But as you do that, you increase the damage that will happen from the deflation and the pop of that bubble. And that wraps up the economic discussion that we have, folks. What about the market? Check out last night's video that I posted publicly in the channel. It was highlights from the stream that we've done on Friday. We talked about a lot of charts, a lot of dynamics, and how to hedge, and how to risk, and how to do this and that. So I'd refer you to that video for the market discussion. But you know that I keep the scoreboard for these indicators, and it kind of gives me a picture on who has the advantage and where the risk is in the market. So if we look at the bullish indicators, the bearish indicators, any change on Friday, the bullish indicators are intact now, but the bearish indicators lost one. The SPX is no longer below the 50 days moving average, it's above. And yields went down a little bit, so I have a little bit of damage here in yields. But as you can see, it's not really a decisive victory one way or the other. The advantage has been shifting day after day from one side to the other as we see this distribution pattern playing out. So while the bullish risk, the upside risk in the market has increased, the downside risk is still intact. And I talked about strategies in that stream video and what I'm doing, for example, keeping longer dated exposure to the downside for a correction or a hedge or a short, and then complementing that with shorter dated upside exposure and upside risk in terms of call options. You combine both strategies, you'll be prepared for everything, because right now the macro is going to take the backseat as we begin to concentrate on earnings. The other thing I want to refer you to, if you happen to be a member in this channel, go check out the latest chart to watch episode, because so far we've done this in December. We'll do another one this week for Jan, but so far 19 of the charts that we covered played out as we anticipated, so there were profits and trades to be made in these charts. We got 4 wrong, and we have about 8 of them that are not definitive yet. They haven't played out, or they're not clear yet. But with that, folks, let's move on to the conclusion of this video. What do we have in the macro calendar for the week? As I said, it's not going to be an important macro kind of week, because tomorrow we got nothing. Tuesday, 21st, we got nothing. Wednesday, the 22nd, we got leading economic indicators. Thursday, Jan 23rd, we got initial jobless claims. And we conclude the week with Friday, Jan 24th. We got existing home sales, the final reading of consumer sentiment, and the flash services PMI, along with the flash manufacturing PMI. Those are usually going to be more important from a macro perspective, but the macro is going to be overshadowed by earnings. We got a few important ones here. They're going to give us a good pulse on the economy, the damage from the rising dollar in the fourth quarter of last year, etc. So you got Procter & Gamble, you got Netflix, J&J, American Express, GE, Verizon, among many others. We have AT&T, we have NextEra, we got Schwab, we got Capital One, Freeport McMoran, we got D.R. Horton, Discover, FICO. We have a lot of companies, United Airlines. We have a lot of interesting earnings coming out this week. And I think that the focus will be on earnings more than the macro. We're going to revisit the macro in the month of February. But right now, for the remainder of the month, I think we're going to concentrate on earnings. What matters at the end of the day from the index perspective is the big cap technology stocks earnings. Those are going to begin to come out next week. But with that, folks, this is all I got for you for tonight. I hope you enjoyed the discussion and found it helpful and informative. And if you did, return the favor by pressing the like button, subscribing to the channel, and engage in the conversation in the comment section. What do you think about all of this? Think it's just a risk for now, or legitimate risk? What do you think the Fed is going to do? Impacting the economy? Engage in the conversation, folks. And consider becoming a member in this channel so you won't miss on the daily coverage that we do. You can join us in the links in the descriptions here on YouTube or Patreon. But with that, once again, this is all I got for you for now. Thank you for listening, thank you for watching, and I appreciate and love all of you. I'll be talking to you again tomorrow. Good night.
Well, yeah.